Because developing new technologies, setting up infrastructure, building robust value chains, and establishing a market for the green transition, it all comes with a cost. Different types of costs. Now we're going to talk about the economic side of it. And the question is, what does it take to secure access to capital? How do we balance public funding and private investments, making the green transition commercially viable while supporting climate goals and sustainable growth? We're going to discuss this with two representatives from the financial sector, one institutional investor and the other from credit and asset financing. And first, I would like to invite Inger-Johanne Rygh to the stage. She is the Director for Governmental and Public Affairs in EU at DNB. So please welcome Inger-Johanne. Nice to see you.
Likewise.
Thank you. You are responsible for DNB's stakeholder management, regulatory and policy engagement in the EU. And Inger-Johanne, she has more than 20 years of experience working with the European financial markets. Now, I haven't told you what DNB is, in case not everyone knows that, but that is actually Norway's largest financial services group. And looking at your website, we can easily see that DNB likes to present yourselves, as having significant influence on the sustainable transition. How do you, as a bank, influence the sustainable transition?
We do that in multiple ways. As we're a conglomerate institution, we have both an asset manager, we have an investment bank side, but first and foremost, we are also a traditional bank, so we can do it on the lending side. And the beauty of doing it on the lending side is that we can engage very, very closely, directly with the customers.
Right. And that means?
That means that going through the transition, we have sustainability targets and a transition planning as an inherent part of our business model. Mm-hmm. That also means that doing lending and doing finance, we set targets also for the customers. But you have to do that. The solutions that are coming to drive energy transformation and sustainability has to come from the market. Mm. So we have to do that. We can finance it, but it has to be market-driven, the solutions. And the solution have to have basis, there need to be an underlying positive business case.
Yeah, so you're not lending money to anyone?
Well, the problem with a lot of transition is that the risk can be high. Mm. So what we do talk a lot about is risk mitigation. Mm-hmm. For some projects, the risk is too high for banks to engage directly without any public measures. And this is a dialogue that's going on in various regions of the globe, and it takes a little bit of a different form depending on how governments approach as well. Mm. So banks can go from market-driven solutions, but a lot can also be done in cooperation with the public authorities.
Right.
Guarantees.
So now you're already touching upon things that I would like to discuss with you and your conversation partner. So I think maybe we should actually get him onto the stage. This is Christopher Weber from BlackRock. That is one of the world's leading providers of investment, advisory and risk management solutions, to quote their website. So you can easily give a hand up to Christopher as well. Hello, Christopher.
Hello.
Now, you are head of climate and sustainability research at BlackRock Investment Institute, and that is part of the BlackRock group. So could you please just explain to us, what do you do at this institute, and what is the institute's role within the group?
Sure. Thanks for having me here. It's what a day to be an American in Europe.
Yeah, we're going to talk about that as well. Yeah.
So I lead basically our climate and transition research for the firm sitting in our investment institute. So basically the internal think tank for BlackRock.
Providing knowledge.
Yeah, so we work with the investors, like in public markets and private markets, to kind of get a sense for, you know, what is happening in like big megatrends around the world. We think the energy transition is one such megatrend, increasingly colliding with other ones like AI, which we were just talking about, like geopolitics, which I'm sure we're going to talk about. And we kind of approach this as observers and investors, and thinking about what the risks and opportunities associated with these megatrends look like. Mm. And on top of that, we also then have clients that have specific sustainability or transition-related objectives. So they might want to, say, have their portfolios reach net zero by 2050. A lot of our European clients have objectives like that. So our job is to sort of research and say, based on where we see the transition going, what kinds of risk and opportunities are you going to have based on those sustainability objectives, based on, again, our research of what we see happening in the world in these megatrends.
So you are actually managing assets for your clients and not investing?
BlackRock is, yes.
Yes.
Like I sit within the Investment Institute, working with the actual investors, portfolio managers that do manage on behalf of our clients, who are individuals like you or me, or institutional investors like insurance companies, pensions, and so on.
So you've already mentioned it briefly, both of you, but I'm curious to know, how important are political signals that are coming? One thing is, markets and access to different types of products or materials, but the political signals that we see, like the Paris Agreement or, trends, does it matter for the work that you're doing on a daily basis?
You want to go first?
I would say yes, it absolutely does. And what we're seeing now with increased geopolitical risk is a higher uncertainty on investment decisions, because you need predictability and you need a stable environment to make investment decisions. And especially when it comes to new infrastructure, like renewable investment projects, you have to have a time frame and a certainty about the investment or the lending that you will be engaging in. So stability and predictability are very important. And we see now, to a certain extent, an increased investment uncertainty or inability to make decisions, because you don't know exactly what technology will be supported, where it will be supported, at what time.
And this is specifically for the energy transition, or is it overall?
I would say that is, well, investments in the energy transitions are very, very large, and they need to run for a long time to be profitable. So maybe that sector in particular, but this is a general observation.
Would you like to add something, Chris?
Yeah, I would just add, building on what was said, like, it's particularly important for long duration type investments, and that's particularly true for things like infrastructure and sectors like utilities, like we were just talking about, who are making these very long-term decisions and trying to invest in a power plant that might last 40 years or a transmission line that might last 50 or 60 years. Policy uncertainty is huge right now. The markets are telling us this, and sheer observation is telling us this, and that, of course, affects investment decision-making and increases risk, which is just another word for uncertainty.
But if we leave the risk side aside for just a little moment, would you say that when it comes to because the IEA, I think they launched a report last year or something saying that the investments in renewable energy would double the investments in fossil projects. I'm not sure if that is still the case, but would you say that access to capital is the bottleneck, or is it just not enough projects to invest in? How do you see that?
Well, I'll jump in and say yes, it's both. And it fundamentally depends on where you're talking about and the regionality. You really have to get down into the region-specific details to understand this better, because those kind of widely cited statistics, like the world is investing twice as much in green as it is in brown, if you will. A lot of that's in China, which is largely uninvestable for a company like ours in the infrastructure space. And it really depends on kind of the depth of capital markets, which are the connective tissue between the sources and uses of capital in different places. And we have very well-developed capital markets in the West. Some in middle-income countries, they're kind of modernizing, and in lower developed countries, the capital markets tend to be much shallower, which of course leads to what was already heard earlier as this large cost of capital differential between emerging markets and developed markets.
Yeah, I would agree to that. It really depends on where you are looking and what regions you are looking to. So perhaps going close to home for Europe, Europe needs to develop its capital market. because there is not enough public funding available to do the necessary investments that are needed for the European economy to grow. That does not mean that there are other parts of the globe where capital is really also, we'll be looking at numbers that are published internationally. Capital is the bottleneck. So it really depends on the regions you're looking at.
But what about public-private cooperation? How can public funding be used to unlock private capital?
Yeah, so what you're talking about, sometimes known as blended finance or concessionary finance, we think that's super key. Any place there is this sort of like higher cost of capital. And the reason why this is because there are both real and perceived risks that are different in places that have higher cost of capital than in others. In addition to technology risk, where you might be seeing a new technology that can happen anywhere, but you can also maybe see that same technology has never been built in a new country, and so you'll have like a higher risk associated with that. You'll have currency risk, you'll have perhaps institutional risk, political risk. All of these things kind of need to be priced into the deal, and like where you have that big risk differential, public sources of finance can come in and kind of buy down that risk such that it can look more like an infrastructure deal that our investors, that our clients might be more interested in, because they're of course used to developing projects in places where capital markets are a lot deeper.
Johanna?
Yeah, the same goes for the lending side. Often in those kind of infrastructure investments, you need equity to go first, and lending will come, and debt instruments will come later. So, you can use a different set of techniques, but public-private cooperation, it could be co-finance, it can be guarantees, you can even have public procurement to ensure duration. So there are various techniques you can apply, but it's for some projects without that kind of cooperation, the risk is too high, especially for the lending side.
And when you're talking about risk, and of course any investor would like to have a return of his or her investment, and they are investing for a certain amount of time, but how can we reduce this risk? You were talking about technological risk, market risk, etc. Is there a way of sharing the risk? Are there some mechanisms that haven't been deployed yet, or what is working?
Yeah, so there's a wide variety of mechanisms that have been tried, and we have 3 different blended finance platforms that we've developed through time. One's like an infrastructure equity program that has kind of builds with development bank finance as the first level, taking the first loss risk, and then infrastructure equity on top of that. We also have another program that we're working with the insurance industry to kind of on the debt side actually, like to basically have catalytic finance come in to finance resilient infrastructure in the emerging world, which is kind of another topic. We haven't talked a whole lot about adaptation today, but like that's obviously another big financing gap. And we also have a third in Singapore, where we have the Singaporean government specifically targeting basically buying down the technology risk associated with industrial decarbonization, which is generally like seen as higher risk because it's harder to abate, and you're adding on country risk on top of that in Southeast Asia. So you have a lot of different structures already taking place, but one of the key challenges in scaling these is that like they are so context dependent, and that there's a lot of work in setting them up, which is why we tend to favor these kind of platform approaches rather than doing these deal by deal things, because the transaction costs are very real in kind of working between public and private capital, and where we can get these kind of platforms in place and then hopefully scale them, we can kind of have models of success that will hopefully buy down the risk and prove out that maybe the risk is actually lower than people think.
And actually helping the transition in that way, of course. Greenwashing, how do we avoid that?
Take that one first.
Yes, that's a huge question, and global standards have done a lot of work. Yeah. Now in addition to the global standard setters, there are different regional approaches. Like Europe has gone very, very down to detail, requiring a lot of data points. And now the question arises: is requiring a lot of data points really what you need to avoid greenwashing? Obviously, you need information to make good investment decisions. That's certain. But whether you need to go very far in the detail or if you can keep it a little bit more at an aggregate level to achieve real transition, there's a question mark now. And this is an open debate in Europe, which is probably the region that's gone farthest on approaching it by detail. I think the most important thing is that it needs to be inherent to your business model. You need to have it as part of your strategy. And you need to work very closely with your clients. You need to know, so access to people, access to competence about the different sectors you finance is really key, because you need to understand where you engage.
And
so
documenting all along.
Yes, and that's the question, how much documentation. Like our annual report now has gone up by almost 200 pages due to European requirements. And it's not necessarily that which makes it easier to read, but yes, you need transparency and you really need to know your customers and the projects you engage in.
Would you like to add anything, Chris?
I'm not an expert in either reporting or in regulation, but to just say, obviously, if you're not aware, there is an incredible amount of regulation around the world on this, and there are real reporting burdens associated with this, even to the point where anti-greenwashing regulation, like from a market-wide standpoint, I'm not talking about BlackRock, has led to a lower number of sustainable funds actually being issued into the market. And it's a real problem that needs to be balanced with the real risk associated with greenwashing and consumer protection, of course.
Interesting point. I think we're going to let the expert panel have a go at our two finance experts. So Anders Hammer-Strømmen, you are still Professor of Industrial Ecology here at NTNU. Go ahead.
Hi, thanks, guys. So I was just wondering, from your perspective, we talked about the emission gaps. They are sort of evident. We can measure them. I was wondering, what's sort of your take on the financing gap? I think the last report from the IPCC talked about a factor of 3 to 6 on global levels in total. That was 2020 versus the 2030 levels we needed to be on to sort of be towards 1.5 or 2 degrees. Being in the sector, how do you think about this finance gap, and how does it look from your perspective?
So maybe I'll start. First of all, there's a really important distinction. There's two things that are called the climate finance gap. There's kind of what I call climate finance with a capital C, capital F. This is like the 100 billion pledge from the global north, and so on, which is the public side of that. And then there's the gap that is basically the investment equivalent of the emissions gap. That is just saying, like, we should be, according to a Paris Alliance scenario, investing 5 trillion a year in green, and instead we're investing 3 trillion in green. So take the difference. So did you refer to, which one of those are you referring to? The latter?
Yeah.
So, I mean, like, my take on that, at least, is that it's just, I mean, it's all of the same problems that describe the emissions gap describe the investment gap. Like, there's no inherent difference between the two. It's just measuring it in a different way, like, if you will. The first one is a completely different story, and one that we should set aside because it's highly political and everything. You want to add?
Yeah, no, I don't. Unless you have follow-ups on, I think you covered it.
Okay, thanks. Franziska Holtz, still, you're a market expert, so.
Yeah, thanks. You talked about asset management, and that reminded me of a question that I didn't get to ask in the first session, so maybe now it's the time. That is about asset stranding, which is a term that we used a lot in the last decade when we talked about premature value losses of fossil assets due to, at the time we defined it as due to unexpected climate change policies. Now we cannot talk about unexpected climate policies anymore, but you still have investments in fossil assets, both physically, as we talked about in the first session, but also financially in utilities that work in fossil sectors. How do you deal with the asset stranding risk? Do you see one? Is it just not there anymore today? Or, yeah, how do you deal with it?
For the moment, our approach is we have not left any specific sector. So on the asset management side, you can choose products that are pure green. But as an institution, we're still engaging with the whole sector, including fossils. And that was a decision we made because we believe that if you want to have real transition, you need to work with the brown, you need to work with the gray. to make them. If you choose to work only with what is already green, you lose out of a lot. So from our perspective, a lot of the discussion that's been on stranded assets can be solved by allowing institutions to work across the sectors. And you do need that. You need, for a stable energy mix, because the problem with renewables, you don't have storage capacity, you don't have grids. So you need, for a safe, secure energy mix for a certain amount of time still, you need to have the combination. And then you need to increase the renewable side quicker and decrease on the fossils. But if you do that, engaging with cross-sectoral with all the nuances, you reduce the problem of stranded assets.
So I've thought about this a lot and approached it more from an academic side, like as a researcher, and worked with. I've long worked on kind of climate disclosures and everything along those lines. So I think there's again a few different types of things that have been described as stranded asset risk. There's the one that's most common is what you described: sudden unanticipated speeding up of the transition, and suddenly an asset that you thought was going to be bringing you revenue for 30 years no longer can, right? I think that is less, that the likelihood of that happening, I think, is generally seen as less now, in part due to all of the energy trilemma, quadrilemma things that we've been talking about today. On the sort of milder version would be like the asset that gets a lower utilization rate over time. So think like you buy a gas plant, you think you're going to get a 60% capacity factor, but then batteries eat its lunch 10 years from down the line, and it's only being used at a 10% capacity factor. If you know what I meant with all of that, I hope you do. That one I think is very real, and I think it's really being considered heavily by investors, like especially in assets that can have a variable operating life. And the final point, again, to bring up physical risk, is the physical stranded asset, like the home that may be abandoned over time because it can no longer get wildfire insurance. And that, again, is a very, very hot topic in insurance and investing right now, and thinking about what the likelihood of that looks like.
Thank you. Any more? Yep, Hans Auer. You need no further introduction now, I think.
So maybe when talking about venture capital for startups, so maybe we are not talking about trillions of dollars, but maybe both of the experts could elaborate how the situation at present is in the US and in Europe, and if you think if the status quo is sufficient, or if we also should much more incentivize, let's say, young talents to start up.
You guys do anything in early stage?
We don't do venture capital, but Europe needs to change a bit its mix of finance. European companies are very heavily dependent on bilateral finance compared to the US, where you do have a lot more of a lot better blend of the financial mix. So non-financial companies need to move to other parts of the market, because you need to increase the supply side as well. So this is a balance. Europe needs to work on both supply and demand. And now I'm speaking about finance. But it goes hand in hand. So we are looking now at, for us as a bank, we're looking at, or Europe is looking at new instruments like securitization, because you need to increase the volumes. The European capital market is not as liquid, not as large as the US market. And that is a challenge also on the venture capital side. But we don't do venture capital. This is an observation of the market.
Yeah, we also don't do a lot of venture capital, but two observations just from monitoring the market. One is that obviously a lot of the shift in the US VC space has gone to AI over the last couple of years. Like climate tech was the thing in 2021, and now there's been a sizable shift to AI startups. So that is a real thing that has happened. But the other thing is that I think at least in the US innovation ecosystem, the early stage has never been the problem. We've generally always had a lot of early stage. What's really missing is the growth stage, like getting the first of a kind, second of a kind, third of a kind, up to a point where it can become like infrastructure equity level investor quality, because we generally are very good at getting companies up to that first of a kind, but then there's a lot of the famous valley of death right there that is problematic.
I would very much agree with that. With Europe as well, there are lots and lots of incentives for startups, but for the scaling phase, then you lose out. There is not enough scaling capital available. Yeah.
Good. If there are no more questions from the expert panel, I think we are, in 4 minutes, we'll probably find out whether we are talking about Liberation Day or Depression Day from your part of the world, Chris. As the final question, are the current deglobalization trends and increased focus on global trade/trade wars affecting the capital flows and possibilities to accelerate the transition?
Probably clear that I am not in a place to comment on specific policies, but suffice to say, today is going to be one of the most watched market events in years, and this is obviously a very big potential shift in the global order. And
global disorder, as we call it now. Well, in Europe, we can call it that.
Yeah. No comment on that. Uncertainty is bad for investment. Period. Policy uncertainty like this is bad for energy investment, regardless of what type of energy investment. And I think CERAWeek was mentioned. I think you heard this as a big undercurrent at the big global energy trade show and conference a couple of years ago. That
there's also uncertainty linked to other parts of the energy sector.
Absolutely, this is it's uncertain regardless of what type of energy you're trying to invest in. Yeah.
Inger-Johanne?
No, it will certainly be interesting to see because it will shift trade patterns. But what we are observing already is that a lot of institutions are working more regionally based.
Yeah.
And a lot can be done regionally, region by region. But you need still to have an eye on, even though trade patterns might change significantly, you need still to look at global alignment to make it happen. But it might be that in a minute and 10 seconds it will be quite difficult.
And yet we have to remember that climate change is a global challenge. So on that note, I would like to say thank you so much to Inger-Johanne Rygh from DNB and to Christopher Weber from BlackRock Investment Institute. Investment Institute.
Yes,
of course, yeah. I was puzzled for a second there. Thank you so much for coming here and sharing your knowledge with us. Goodbye.
Thank you.
Now,